Hi, Karen. Thanks for coming today. If you could just introduce yourself.
Sure. I'm Karen Chan. I am a personal finance educator. This is what I've been doing for about 27 years. As Ashley said before, the first 20 or so of that was with University of Illinois Extension, but I so-called retired from there several years ago. But because personal finance education seems to be what's in my blood, that's what I'm continuing to do. As far as qualifications beyond years of experience, I am a certified financial planner, but I do not practice. In other words, I don't take clients. I've chosen to use that training to provide better education for folks like you who are listening today. And I do not sell any financial products or services. And my goal is really that the information that I share with you today and in any other presentation that you may see me in is that the information is as informational, unbiased, and well-researched as I can make it. And about today's program, today is education and it's not advice. And let me kind of give you an example of where I draw the differences. With education, I mean that I hope you will leave today saying, I learned this and either I or I, along with my financial advisor, need to decide how to apply that in my situation. Not you leaving the program today and saying, oh, Karen Chan said I should take my distributions this way. No, I'm not giving advice. I'm trying to give you information to help you make more informed decisions. Retirement income planning and income taxes, which we're going to have to touch on a fair amount today, are both complex areas. And I wouldn't be surprised if after today's program, you may decide that you do need some professional advice. If so, do seek a qualified professional, whether it's an attorney, whether it's a tax accountant, to make sure that this topic is something that they are intimately familiar with. And along the way today, I am going to refer you to a few different resources. And just so you know up front, those will all be available on my webpage at karenchanfinancialed.com. Click on resources, and then you can click on the name of this program, or if it's another topic that you need help with. So exactly what are we talking about today with distributions from retirement accounts? We're talking about four main types of retirement accounts. IRAs, we'll talk about probably the most, but almost everything that we talk about will almost apply to 401ks and to a slightly lesser extent to 403bs and government 457 plans. Now, in our retirement planning landscape here in the US, now in any of those four types of retirement plans, you can have two flavors. You may have the traditional tax deferred version, where you put money in today, you get to reduce your income by the amount of that contribution. And when you take the money out later, that's when you'll pay the taxes. The second flavor is the Roth, or tax exempt growth version. With a Roth, when you make a contribution, you do not get any tax break in that year. The tax break comes down the road when you take the money out, and any growth in the account will be tax free. So we're going to talk about both of those. Today, especially, there's more than one way to take money out of your account. Largely because of coronavirus, there's some new information about both loans and hardship withdrawals. So we're going to touch on those first. Then we're going to focus on rollovers and conversions and spend the majority of our time on the last two about actual distributions, meaning that you are taking money out of your account. You're not moving it somewhere else. You're actually taking the money out of your account and either going to use it, or if you're going to put it somewhere, it will be in a non-retirement account. And then we'll talk about beneficiary rules, which is where we've had significant changes as a result of the Secure Act passed at the end of last year. So let's start with those loans. Loans are not available from IRAs. So here we're talking about 401ks, 403bs, and 457 plans. Loans are only available if your plan allows it. The federal government allows it, but in order for you to be able to take a loan, your employer's plan must allow it. The usual limit is The lesser of 50% of your vested balance, not your entire balance, but your vested balance if you're not 100% vested yet, or $50,000 if that is less. Now, if you are relatively new to your job or the amount that's in your account is small, if the vested amount is less than $10,000, then you could actually borrow 100% of it. The general repayment rules are you repay in 5 years, although you can have longer if the money was used for a home purchase. Here's the catch. If it's not repaid when you leave employment, you are likely going to end up with the balance of that loan as taxable income unless you're able to repay it quickly under special terms. If you're not yet 59 and a half, that balance will not only become taxable income, but likely have a 10% penalty as well for early distribution. You may have the ability to roll over the amount, the balance that you still owe, to roll over an amount equal to that into an IRA. You'll want to get some good tax advice from a professional if that's your intent. Obviously, most of us who take loans don't intend to leave our jobs, but you need to understand that that is a risk. There are some special loan rules under the CARES Act that was passed last March. Mainly, they've increased the loan limits, although that expired in September. So if you have not yet taken a loan and were hoping to make use of those higher loan limits, unfortunately, you've missed the deadline on that. What is still in play, if you already have a loan, for anybody who had an outstanding balance as of March 27th, when the act was passed, or later, with any repayment due by the end of this year, your repayment can be delayed. The actual start date could be delayed, and you can have that extra year to repay. That is still current information under the CARES Act. Now, hardship withdrawals are a completely different animal. A loan has to be repaid. A hardship withdrawal, historically, has meant that you had to prove that you were experiencing financial hardship. Sometimes that was a high hurdle to pass. And once you took the money out, there was no going back. There was no putting the money back into the plan. So those are the permanent rules. And the permanent rules mean it was only for employer plans that were not IRAs. Again, the plan had to allow the hardship withdrawal. Federal rules allow it, but they do not require employers to allow hardship withdrawals. There were some other restrictions that were relaxed last year as well, but the hardship withdrawal is going to be taxable income, cannot be rolled over or replaced. But then comes the CARES Act, which enacted the coronavirus-related distribution. Say that 3 times fast. We abbreviate it as a CRD, coronavirus-related distribution. These distributions have special rules, much more lenient than normal hardship withdrawals. These apply both to employer plans and to IRAs through the end of this year, assuming that the plan did adopt these rules. But to be eligible, you have to be a qualified individual. That means that you have to have experienced some type of financial hardship related to coronavirus. For example, you or your spouse were diagnosed with COVID-19, or you suffered other adverse financial consequences as a result of the pandemic, probably related to something like being quarantined or furloughed or being unable to work because childcare wasn't available. The CRD can be up to $100,000. It is still taxable income, but you would only pay the tax spread over 3 years, so you wouldn't have the full tax bill hitting you at once. They have carved out an exemption here for that 10% early distribution penalty. So even if you're only 45 or 50, the 10% early distribution penalty will not apply. And here's the most amazing thing. They've basically turned this into an opportunity to do a rollover if you're able to. There'll be no tax if you repay this distribution within 3 years. Now, make sure that your plan allows rollovers into the plan. They have to allow that in order for you to be allowed to repay. And just a heads up that if you do take a distribution of this sort and repay it, especially if you're repaying it in future years, not in the year you took the money out, you may be filing some amended tax returns that could get a little complex. But those are two things, the coronavirus related distribution and the loosened rules for loans from employer plans that the CARES Act put into place for this year. So now let's get into the topic that is going to apply probably to a greater number of you. And let me just say at this point, we're covering a lot of pieces, a lot of different types of information today under the context of taking distributions. Some of it won't apply to you. And so just like with the previous two things, maybe that's not useful to you. Well, just hang on. I'm sure that some of the other parts in here will be. If you printed out the handout, so that if you look back at this later on as reference, you might cross out the things that you know don't apply to you. Cross out the slides that are irrelevant in your situation. That will help you later on focus on the parts that actually do apply for you. So what do we mean by rollover? You're moving money from one retirement account to another. If the money was tax deferred, you were able to continue to defer taxes. If it was a Roth account where you were going to have tax-free earnings distributed down the road, you will be able to preserve that tax status. Employer plans may or may not allow you to do in-service rollovers, meaning that if let's say I was still working for the university and I had a 403B account, I might or might not be allowed to take money out of that 403B and move it somewhere else. The federal law may say that I can do it, but does my plan allow it? And that's the question I'm mentioning here, that employer plans may or may not allow in-service, meaning while working, rollovers. Now, what money cannot be rolled over? Required minimum distributions. You've all known in the past, the rule was that at 70 and a half, you had to start taking minimum distributions. The rule now is 72. Those are referred to as required minimum distributions, or RMDs. RMDs cannot be rolled over. You must take it out of your retirement account, and you cannot put that money back into any retirement account. If you are going to do a rollover of the additional money that's in your account, you should take your RMD first and then do a rollover once you have already met the requirements for your RMD for that year. You have some choices about exactly how you roll over money. Direct or trustee to trustee transfer. These top two they work the same, they simply involve different types of accounts. A direct rollover goes from one retirement plan to another or to an IRA. The trustee to trustee transfer works exactly the same way, but it's starting from an IRA. So you have money in an IRA and you're moving it either to another IRA or another employer plan. Direct and trustee to trustee are similar in that they go from custodian to custodian. The money does not go through your hands, or at worst, it's a check made out to the new custodian that is sent to you, but you still do not have control of the money. And that's the key factor that makes these different from the third bullet here, which is a 60-day rollover. I was taught to call this an indirect rollover, where the money is paid to you, and then you have the burden of redepositing that money to an IRA or another retirement account within 60 days. But there are issues, potential issues, with these 60-day rollovers. I already mentioned that you only have 60 days to complete it. If you fail to get the money redeposited somewhere in another retirement account within 60 days, it becomes a taxable distribution. Not good news. Here's the thing that makes it difficult. There may well be withholding. In most cases, there is withholding from the distribution if you are getting the money yourself. If it's from an employer plan, it's mandatory that your employer, or rather the plan manager, withholds 20% for anticipated taxes. On IRAs, the default is 10%. You can request for it to be none, but unless you remember to do that, there will be 10% withheld. If you roll it over, yes, you won't owe that tax, but you'll have to wait until you file taxes next year to get that money back. And so in the meantime, in the purple bubble over here, we point out that you will have to come up with money from other sources to replace the amount that was withheld so that you can deposit a full amount of your distribution. Let me give you an example. Let's say that you took out $10,000 from your employer plan, your old employer plan, with the intention of rolling it over to your IRA. But when you got the check, it was only for $8,000 because $2,000 was withheld. If you only deposit $8,000 into your IRA, you have a $2,000 taxable distribution. To avoid that, you must come up with $2,000 from somewhere so that you can redeposit the entire $10,000. So this is one of the complications of doing a 60-day rollover instead of one of the direct types of rollovers. If you miss the 60-day limit, you can ask for a waiver. There's an automatic waiver if you document that the financial institution received the money in time but failed to deposit it or credit your account on the right day. You can go to the IRS and request a private letter ruling, but that'll cost you $10,000 just to get the ruling. The newest thing is that the IRS will allow you to self-certify if the reason you were late was because of one of 13 specific reasons, such as postal error, serious illness, that a check was misplaced, or so forth. But once the error is discovered, you also will have to show that you acted in a timely fashion and deposited it ASAP. The better solution is don't mess with the 60-day rollover. Just do the trustee to trustee transfer if it's coming out of an IRA, or do it as a direct rollover if it's coming out of a retirement plan. In those situations, often you simply go to the place where you want the money to go and you complete paperwork with them authorizing them to go and get the money from your prior account. Clean and simple. Maybe not fast, but clean and simple. Keep in mind that in the last few years, we've had a new rule in place that limits you to one rollover from an IRA per 12-month period. Now, there's a fair amount of detail in this heading. Notice that it is 12-month period, not calendar year. And notice that the limit of one rollover only involves money coming from an IRA. So what does not apply, what does not count as your one rollover per 12 months? If you did a conversion from a traditional IRA to a Roth IRA, that's a conversion, it's not a rollover. If you did a trustee to trustee transfer from an IRA to an IRA or from an IRA to a retirement plan, if you did it trustee to trustee, it doesn't count. Also, it doesn't count if you did a rollover from a retirement plan to an IRA or to another retirement plan. So we're really talking about indirect. We're talking about 60-day rollovers that you are limited to one. There's a special rule for beneficiaries. If you were not the original owner of the account, beneficiaries can only do direct rollovers. They are not allowed to do a 60-day rollover. So you can, if you were the beneficiary, you can roll the money from one inherited IRA to another, or from the employer plan that you inherited to an inherited IRA. But note that the title has to remain the name of the deceased. You're named only as the beneficiary. So for example, if John Doe passed, you are the daughter Jane Doe. Then no matter if you've moved the account must remain titled the account of John Doe for the benefit of Jane Doe. John Doe's name has to stay on there. If as a beneficiary you did attempt to do a 60-day rollover, it is not allowed. And the end result will probably be that you will have been deemed to make a distribution of the entire amount, and that will end up being 100% taxable to you in the year that you try to do the 60-day rollover. Now let's talk about conversions. This is something that typically there are lots of questions about. And as Ashley said, feel free to make note of your questions in the chat or the Q&A so we can handle those at the end. A Roth conversion means that you are taking money from a traditional account, you're moving it to a Roth account, and what you're converting is you're converting the tax nature of that money. It will be taxable income. You're taking it from a tax-deferred account where the agreement was that when you took the money out, you would pay tax on it. So you are going to pay tax when the money comes out of that account, but you're allowed to redeposit it into the Roth IRA and change it into money that has already been tax paid, and now you're entitled to tax-free growth from that point on. A lot of people are under the impression that this isn't really doable for them because they think, oh, I've got this $50,000 IRA. If I don't want to take $50,000 out and put it in a Roth and have $50,000 of taxable income, that's just going to be a lot of tax. Well, you can strategize. You might decide that you will convert just $10,000 this year. Next year, maybe you look at your tax situation and you say, I can convert 15,000 and stay within my current tax bracket. So you can do partial conversions to help you manage that tax bill. If you have a traditional IRA where you made non-deductible contributions, you might have non-deductible contributions if your income was too high for you to deduct any or perhaps part of the contribution you made that year. You should have a form that's been filed each year with your taxes that would note that you have non-deductible contributions in your traditional IRA. It is true that when you convert that money into a Roth, that because you didn't get a tax break on it when it first went in, it was non-deductible. It's true that that money will not be taxed when it's put into the Roth IRA, but here's the problem. You cannot cherry pick which money you convert. Let's say you have across all of your IRAs, that's how you would have to do the calculation. Let's say that across all of your IRAs, the portion that was non-deductible is only 10%. 10% was non-deductible contributions. That means regardless of which IRA you convert from, only 10% of that will be non-taxable, because that is the proportion across your total IRA balances that was non-deductible. This is called the cream in the coffee rule, meaning that once you've mixed your non-deductible and deductible IRA contributions, you can never really separate them. There are different ways to do Roth conversions. The first is to do an in-plan conversion, meaning that, let's say that in your employer plan, maybe it offers both tax-deferred, aka traditional, and Roth versions. You can actually convert from traditional to Roth right there within your employer plan if it offers both. You could also take tax-deferred money from your retirement plan, from your employer, and put that into a Roth IRA and convert by moving it from retirement account to Roth IRA. Or if the money is already in an IRA, you simply move it to a Roth IRA and make the conversion that way. Some of you may remember that there were rules previously that sometimes you had to do a two-step. If it was coming out of an employer plan, you had to put it first into a regular IRA and then convert. That's the old story. The current rules allow you to do conversions in all three ways that I've just mentioned. So who should consider doing a Roth conversion? Well, this could be applicable to a lot of people this year. If this is a year where your income is significantly lower than usual, or for many of us in our later years, or as we work with our parents as they age and become more frail, there might be a year when your parents or you eventually have huge medical deductions, huge medical costs that allow you to actually itemize deductions and to itemize those medical expenses. Both of those situations, low income or huge deductions, mean that you're likely in a lower tax bracket than you are normally. And you could take advantage of that by doing a Roth conversion and filling up that lower bracket that you're currently in. Some people want to do a conversion because they want to avoid required minimum distributions. Now, take note, the only account that avoids required minimum distributions is the Roth IRA. Others want to do the conversion because they're concerned about the size of their estate and estate tax. Now, under current rules for 2020, an individual can leave about $11.5 million without owing estate tax. And so estate tax only becomes an issue if your estate is larger than this. But in that case, individuals will choose to take actions that make them pay income tax now so that it reduces the amount of money left that will pay estate tax later. Estate tax is higher. Estate tax begins at a higher tax rate than our highest income tax rate now. That's why it's a no-brainer. But remember that in 2026, barring additional rule changes, that we're going to go back to the old rules about who is subject to estate tax, and it will go back to $5 million per person plus whatever inflation increments will be added to that $5 million number. All right, we've dealt with loans, we've dealt with hardship withdrawals, we've dealt with rollovers and conversions. Now let's talk about the situation where you actually take money out, period. It's not going back anywhere. You're not taking a loan. You're not qualifying for hardship. You're just taking money out. So I'm going to call these regular distributions. The rules that apply depend on your age. Now, the big box on the right-hand side is the one that most of us know. We know that starting at age 72 and beyond, used to be 70 and a half, but as of this year, it's age 72, that we all have a required minimum distribution from each retirement account that we have. We need to take those RMDs by December 31st of each year. Now, your required beginning date, the deadline for taking your first RMD, you actually have a grace period. Instead of the deadline being December 31st, for your first one, you could delay and use the grace period that goes all the way through April 1st of the following year. Whether or not you use that grace period for most people boils down to a tax-driven decision. It's whether you want that taxable income, because RMDs are taxable income. Do you want that RMD to be taxed in the year you turn 72 or the following year? If you, for some reason, had higher income in the year you turn 72, you might not want it that year. The grace period might be a good idea. But if your income is generally stable, you might be wary of using the grace period, because that means you'll have your RMD for the year you turn 72 being taxed in the year you turn 73, and you'll have to take another distribution for the year you turn 73, resulting in 2 taxable distributions within that one calendar year. Do not mess around with these RMDs. If you don't take the amount that you were supposed to take, the penalty is 50%. 50% of whatever amount you were supposed to take and did not. Now, there are some waivers that you can request for a reasonable cause, but again, better to just get it right to start with. But if, because of illness, because of some reasonable cause, you can request a waiver of that penalty. Now, what about if you're not 72 yet? What rules apply to you? Well, let's start with the younger group. If you are not yet age 59 and a half, your distributions will be deemed early distributions. Typically, those are going to be subject to a 10% penalty, although on the next slide, we'll talk about the exceptions to the 10% penalty. And also, the penalty does not apply to state and local government 457 plans. It will apply to nonprofit 457 plans. And as I said, there are exceptions, and we'll talk about those momentarily. But if you're between 59 and a half and 72, sometimes I call you the golden group, because you can do whatever you want with your retirement money. There are no penalties. as far as I know, there's no way to get a penalty if you take money out during those years. There are no requirements for you to take money out, so you're free to do whatever you want. You need some money, take it. You don't need it, leave it alone. Anything you do is fine. Now, back to those early distribution penalties. These are the main exceptions. There are a few others that are less often used, but the main exceptions are the death of the account owner or the disability of the account owner, or if there was a divorce and the account was separated as a result of a quadro, a qualified domestic relations order. You can also take distributions under what professionals refer to as Rule 72T, where you agree to take a series of substantially equal payments over several years or until you reach a certain age. That is one way of working around penalties if you really must take money out early. Now, money in an employer plan, if you have left the employer and you were at least 55 when you left that employer, there will not be a 10% early distribution penalty on money that you take out there. But that rule only applies to employer plans. IRAs, though, do have their own special exception for both qualified higher education expenses and first-time homebuyer expenses. And on the resource list that I mentioned on my website, you can get more details about these and the other less often used exceptions to the early distribution penalty. The Secure Act was passed at the end of 2019. And took effect generally at the beginning of 2020. I expected to be teaching a whole lot about those new rules, but the pandemic overshadowed the whole thing. So this is one of the first places I'm talking about new rules that were enacted by the Secure Act. We'll come to more later. But a new exception for early distribution penalties is if you experience a childbirth or an adoption, that you can take out up to $5,000 per parent per qualifying event. So for example, if you adopted twins or had twins, and this distribution can actually be repaid. So again, you can turn it into a rollover. The CARES Act passed in March, once the pandemic was sort of hitting its full impact, also put some special rules in place, but just for 2020. First of all, for 2020, there are no RMDs. There are no required minimum distributions for anyone, not just for the original account owners, but also if you are the beneficiary, if you inherited an account and you are supposed to be taking RMDs generally every year. No RMDs this year. There are a few exceptions. The one that you're most likely to run into is if you already set up an annuity from your employer plan or your IRA, or if you were taking out that series of substantially equal payments in order to avoid the early distribution penalty. Those two situations, you will need to continue making distributions. If it is a pension plan, that's what we mean by a defined benefit plan. If you're already receiving pension payments, those must also remain in place. If you had already taken your RMD earlier in the year before this exception was put in place, there were some extensions made to allow you to roll over, and actually the extension was originally July 15th. It was delayed again until sometime in August, I think, but that window again has closed. So unfortunately, if you'd already taken your RMD, you've probably missed the window to do that, make that a rollover, unless you can do the coronavirus related distribution. That is going to be your backdoor method of getting that RMD back into the plan. But again, to determine it is a coronavirus related distribution, you must have experienced some hardship because of coronavirus. Now, One of the biggest questions I get from people is, so how are these required minimum distributions calculated anyway? Well, here's the formula. You start by looking at your account balance from the end of last year. So, well, we're not taking RMDs this year, but if we were, this is how it would be calculated. We would look at the statement from the end of last year, December 31st. What was my balance in, let's say, my IRA? I would go to this table called the Uniform Lifetime Table, which the IRS has available in publication 590-B. It's in the appendix. Just download or view this publication online and look in the appendix for the Uniform Lifetime Table. Find your age. Let's say that it's 72, and you get the number that's next to it, the distribution period, 25.6 for people who are 72 this year. You divide 25.6 into the balance from December 31st. The result is your required minimum distribution. And as I said previously, except for your first one, it must be taken by December 31st. So no RMDs this year, but next year, 2021, if you are 72 or older, you will have RMDs, barring further legislation. And this is how you will calculate it, by looking at your statement from the end of 2020, looking up the distribution period for the age of your birthday that you will celebrate next year, and doing that by December 31st. The interesting thing about the Uniform Lifetime Table, and actually I'm going to go back here for just a second. At age 72, your distribution period is 25.6 years. Did you wonder where that 25.6 comes from, or where the 24.7 comes from for age 73? Well, it doesn't look like life expectancy, does it? Because at 72, don't think we necessarily expect to live to 97. So what is this? Well, it's based on not just your age, but the federal government has given you a theoretical spouse who is 10 years younger than you. And so these distribution periods are based on the joint life expectancy of you and this theoretical spouse. Now, if you have no spouse, you still have a theoretical spouse. You still get the benefit of having a spouse that's believed to be 10 years younger than you. Why is it a benefit? Because it gives you a longer distribution period, which in turn makes your required minimum distributions smaller than they would be if it was based on your life expectancy only. You can always take more than your RMD. So this is sort of giving you the benefit of the doubt. They're going to give you a calculation that gives you a smaller RMD than you might really be entitled to, but that means that you're not forced to take out any more money than that, but you're allowed to take more money when and if needed. Now, if you happen to have a spouse who is more than 10 years younger, you will be given credit for that younger spouse. You will use a different table. It's in the appendix of that same publication, but it's called the Joint and Last Survivor Table. And you'll look up the age of one spouse across the top, the second spouse across the side, down the side, and you'll come up with your distribution period, again, based on your joint life expectancy. Now, the Uniform Lifetime Table and the Joint and Last Survivor Table, these theoretical spouses or spouses more than 10 years younger, these rules only apply to the original account owners, not beneficiaries. Beneficiaries do not have theoretical spouses, and they use yet a third table, which is simply called the Single Life Table. And this table really does use life expectancy as the way to calculate how much your RMD will be. Generally, you must take a required minimum distribution for every account you have, with two exceptions. The first is if you have multiple IRAs, you can add them together and calculate your RMD, and then it is up to you how you take that distribution. You could take the whole amount from just one IRA, even though it's the distribution for all of them. You could prorate it. It doesn't matter how you do it, as long as you take the correct amount out of any IRA, then you are good to go. The same thing applies if you have multiple 403B accounts, so that you would add them all together calculate the total RMD, and then it's up to you whether you take it from one or more of your 403B accounts. There is one more exception to RMDs that I should mention. If you have an employer plan or you're a business owner and you are still working for that employer, or you still own and are active in that business, you do not have to take an RMD in that plan until you stop working. If you have plans with former employers, or if you have IRAs, you do have to take RMDs from those. So this still working exception only applies to the plan at your current employer. Now, to me, this is the biggest news that we have had in a couple of decades regarding IRAs. It doesn't apply to everyone, but we now actually have a way to avoid tax on our required minimum distributions. And it is by doing something called a qualified charitable distribution, or QCD. How does it work? First of all, you can only do a qualified charitable distribution if you're taking money from an IRA. And because SEPs and Simples are technically employer plans, those don't work. I don't know if Congress just missed dotting their I's and crossing their T's, but qualified charitable distributions are available for anyone who has reached age 70 and a half by the date of the distribution. They did not change this to line up with the new required beginning date for required minimum distributions. They left it at 70 and a half. The way it works is you have your distribution sent directly to the charity of your choice. Now, you could have your plan send you a check that is made out to the charity, cannot be made out to you. They can send you the check so that you have the pleasure of delivering it. But typically, you simply instruct your custodian to send the distribution directly to the charity of your choice. The maximum is $100,000 per person per year. And this has always been a really useful tool from a tax perspective, but it is particularly useful between now and 2025 when we have the much higher standard deduction, resulting in most of us getting no tax benefit from charitable contributions. We typically now, most people are not itemizing, and the only way you would get a benefit from a charitable contribution normally is by itemizing. This gives you a second route to benefit from a charitable contribution. Let's kind of compare the difference between doing the qualified charitable distribution, that's over on the right-hand side, versus doing itemized deductions and making your contribution from non-IRA money. So let's start with the right-hand side. First of all, for 2020, the standard deduction this year, and this is for a married couple, is $24,800. You're going to get that $24,800 standard deduction regardless of whether you make charitable contributions, regardless of what your property taxes are. This is where you're going to be unless your total exceeds that amount. And let's say that you took out, now in both examples here, we're taking out $10,000. We're contributing $10,000 to our favorite charity. By doing a qualified charitable distribution, we're going to avoid tax on that $10,000 of income. And so in 2020, by using the QCD alongside our standard deduction, we're deducting $34,800 from our taxable income. The alternative is the left-hand chart, where we made our $10,000 charitable contribution with regular money, not from our IRA. So in this case, the only way we get benefit is if we itemize deductions. This couple does have enough itemized deductions to get above the $24,800 mark, but their itemized deductions only take them up to $27,000, meaning that they only got a tax benefit for a little over $2,000 of this contribution. You can see that in most situations, especially under the way the tax code works now with the standard deduction, if you're eligible to do the qualified charitable distribution, that from a tax perspective is likely to be far better for you than writing the check out of your checking account to do the same thing. And by the way, you cannot take money from your IRA and then write a check to the charity. You cannot get the check from the IRA made out to you and endorse it over to the charity. The money has to not ever be under your control. It must go directly from your IRA account to the charity. And remember, you must be 71 and a half on the day. You must be at least 71 and a half on the day that you do this. This is another explanation about benefits between the QCD and itemized deductions. We've pretty well covered this, but if you're in particular income groups, there may be issues that you would also benefit from regarding reducing the amount of Social Security benefits that are subject to tax, perhaps avoiding some net investment tax for higher income folks, and so forth. Now, this is the bad news. This is the complication that arose this year with the change in the required beginning date for RMDs by going up to age 72 and not changing the age at which you're allowed to do a qualified charitable distribution. So somebody got worried that you're going to try to game the system here. And so they're worried that you're going to make a qualified charitable distribution, but you're going to continue to make IRA contributions because, by the way, that's another change. As long as you have taxable, as long as you have earned income now, you can continue to make IRA contributions. In the past, you couldn't contribute any longer once you hit age 70 and a half. So somebody's afraid that you're going to like put money in and then take it right out with a QCD. So they came up with these anti-abuse provisions. And what it boils down to is, if you make a deductible IRA contribution in the year you reach 70 and a half or any later year, then your qualified charitable distribution is going to be disallowed until you've basically used up the amount of those contributions. So the simple way around this is, if you want to do qualified charitable distributions, don't make further contributions to your IRA after age 70 and a half, even if you do have earned income. There may be some more sophisticated strategies around that, but for that, you'll need to talk to an expert tax advisor for those alternatives. Now, let's talk about Roth accounts. With Roth accounts, you've already paid tax on the amount that you contributed. Therefore, there's never any tax or penalty when you take out your contributions. Only the growth could ever possibly be taxed or have a penalty, but there's no tax or penalty if you follow two simple rules. The first is that the account must have been open at least 5 years, and you must either be age 59 and a half or older, or dead, or disabled. 5 years and one of these three criteria. Then all growth is tax and penalty free. When you take money out of a Roth, generally those distributions are deemed to be a prorated mixture of contributions and growth. The exception is a Roth IRA. And I mention this because here's something that, especially for younger adults, can be very valuable. With Roth IRAs, contributions are distributed first. It's not prorated. So when my niece, who was about 28, decided that she actually had a couple $1,000s she would like to put into an IRA, she thought the Roth IRA sounded like a really good idea for two reasons. One, she was coming into the job market back in like 2010 when the economy was still in the pits and she wasn't earning much. So a tax deduction wouldn't save her much. A Roth made a lot more sense. And over the next 40 years, before she'll probably take the money out for retirement, If she should need to tap some sort of emergency fund that she doesn't have like ready in a savings account, she could take her contributions out of the Roth account. Contributions come out first, no tax, no penalties. She could use it as a secondary emergency fund. The other special rule that applies more to older adults, where Roth IRAs is concerned, that there are no RMDs, no required minimum distributions for the owner. However, there are for beneficiaries. And Roth IRAs have this other exception that appeals to younger savers, that if you're using the distribution for first-time homebuyer expenses, then that is an exception for any taxes or penalties as well. Just a word about annuitization, meaning that rather than taking annual distributions, you can, in many IRAs and many employer plans, choose to convert the balance in your account into an annuity, getting a guaranteed monthly benefit for life. You can choose to have it start immediately, or many plans will now let you choose to have it deferred, a guaranteed monthly amount starting at some later date in the future. If you have annuitized, those annuity payments fulfill your requirements for RMDs, no problem. Now let's talk about beneficiaries. The most important thing you want to remember about beneficiaries is please name them. Name beneficiaries on your account. You want to name primary beneficiaries and secondary beneficiaries. The obvious benefit here is that this avoids probate. But the Secure Act made changes to how beneficiaries take money out of your accounts. And these changes went into effect this year for most retirement plans. And so this may impact who is your best choice for your beneficiaries. Like I say, for most accounts, these changes went into effect at the beginning of this year. However, it is delayed until the beginning of 2022 for government plans, annuitized annuities, and so forth that I've listed in the details here. Under the Secure Act, we now have 3 types of beneficiaries. In the big green box, you'll see the dark green box, I'm talking about designated beneficiaries. Designated meaning that you have named them. And then we have a smaller green box that says not just did we name a beneficiary, but and that it's a person, but we have certain designated beneficiaries who have special rights, and they are called eligible designated beneficiaries. So what is an eligible designated beneficiary? It's someone who has the opportunity to spread distributions out over a longer period of time. Stretch IRA no longer applies to just anybody. Stretch IRA, meaning able to stretch distributions out perhaps as long as your lifetime, now is only available to eligible designated beneficiaries, who are surviving spouses, disabled persons, chronically ill persons as defined by the law, someone who is close in age to you, no more than 10 years younger, your minor child, or certain trusts. If it's any person other than these, then they are simply a designated beneficiary, and they're going to now be required to empty the account more quickly than in the past. Now, over in the purple box, these are referred to as non-designated beneficiaries. It's easier, I think, to refer to them as entity beneficiaries. They're not people, so non-persons, if you will. So if you name a charity, certain types of trusts, or if you name your estate, or you fail to name anybody, which makes your estate the default beneficiary, you have a non-designated beneficiary, which means you're going to be under the worst rules, or the recipient will be under the worst rules for distributing the account. You may have seen headlines about, the death of the Stretch IRA. This is what they're talking about. These are now the general rules for distributions. If you have an eligible designated beneficiary, they can still stretch the distribution out based on their life expectancy. That was previously the general rule. If they're an eligible designated beneficiary, they must take an RMD each year. That's also what the previous rules would have been. But note that if we are talking about a minor child and that's how they're qualifying to be an eligible beneficiary, that eligible designation only lasts until they reach the age of majority. So don't be lulled into a sense of security here if you have your children, your young minor children named as beneficiaries. That doesn't quite work the way you might think it was. Once they reach age of majority, then they only have 10 years to empty the account, not their lifetime. If you've named an individual who is not an eligible designated beneficiary, then they're simply a designated beneficiary. And their rule is now they must empty the account within 10 years. There aren't even any required minimum distributions in the first 9 years, but they must empty the account in year 10. The news made a big deal about this. The reality is that most people, most beneficiaries empty the accounts this quickly anyway. So for many of us, it's not that big of a deal. But if you have a very large IRA or a very large employer plan, this is where things are going to start to get a little messy. Now, for those entities, the ones who are not people, generally the rule is take the money out within 5 years. Don't even have to take any money out in the first 4, but you have to empty the account within 5 years. The spouse is unique. The spouse can either be an eligible designated beneficiary and take RMDs over their life expectancy, or first column, they can actually take over ownership of the account. If they take over ownership, it means they can name their own beneficiaries. The rules for distributions will be based on their age, not the deceased. That means that if they are younger than age 59 and a half and need to take money out, they're going to pay an early distribution penalty. On the other hand, they will not have to take any money out until they're age 72 if they don't need it. And so this may be enabling them to delay any distributions until that point. So you have to, if you're a spouse, you have to weigh the benefits, and it's largely dependent on how old are you and do you need money sooner to decide whether to treat the account as your own or whether to take as a beneficiary, and you would be an eligible designated beneficiary, meaning stretching the distributions over your lifetime, resulting in relatively small RMDs. Now we're going to talk about the main impact of the Secure Act, and I'll be very upfront with you here. If you have not used a trust as the beneficiary of your retirement plans, this section probably doesn't impact you. So I'm going to give the highlights, and if some of you are impacted by this and you want to talk more about details, say that in the questions in the chat, and we will come back to this section. For people with large IRAs and large retirement accounts, one of their typical goals is to stretch out the distribution so that less taxable income is generated in each year. That's why now having most people have to empty the account within 10 years is a big deal. You know, if you've got a $500,000 or $1 million IRA or 403B. But with the changes, it can now be more beneficial than in the past to name a spouse if you're trying to stretch things out over the greatest number of years, because a spouse can take the account as their own, or even if they leave it as an eligible themselves as a beneficiary, they will stretch the distributions out over their lifetime, and then whoever inherits it next is going to have at least 10 years. That may be the biggest stretch that you can get. The new rules also mean that naming very young beneficiaries is less advantageous than it was in the past. Previously, if you named an 18-year-old as your beneficiary or a 17-year-old, you thought that they would be able to stretch these distributions out over potentially 60 years. Now, 10-year rules applies, but they get the time until they reach the age of majority based on life expectancy. But once they reach the age of majority, they only have 10 more years to empty the account, which is going to take you up to what, 28. Naming a trust is much less advantageous in the past. You may already be aware that when you name a trust, either the trust is treated as a non-person and it has to be emptied within 5 years, or if the trust qualifies as a see-through trust, you were able to still get this stretch that you used to be able to get. Well, now that's largely gone out the window. Like I said, I'm not going to talk about these details unless some of you really, really want or need this, but I'll just point out this. This really summarizes everything that's going on now with trust. The first question is, do you have a see-through trust? One of the previous slides defines what that is. Once you know whether it's a see-through trust, then you have to know whether it's discretionary or conduit. You have to know who the beneficiaries are, and you'll work your way through my diagram here, and you will eventually determine whether the trust is an eligible designated beneficiary, which means you get the stretch distribution over life expectancy, or if it's simply a designated beneficiary, which means they have 10 years to empty, or if it's non-designated and you only have 5 years to empty it. There are further complications beyond this, and just quickly, even if your trust qualifies as a designated beneficiary, depending on how the trust is written, it might say that you only pay out to the beneficiaries when there is a required minimum distribution. Well, there are no required minimum distributions in the first 9 years. And so in this case, all the money will be distributed in year 10, meaning all of that taxable income in 1 year. This is the kind of worst case scenario that can happen if you have a trust as a beneficiary and don't review your plan with an attorney who is knowledgeable about the impact of the new rules. So I've thrown a lot at you today. What actions do you think you need to take? Literally, take a moment right now and think. Maybe you made some notes as we went along. What were the things that occurred to you that you need to take action on? Do you need to name beneficiaries for the first time? Do you need to review your beneficiaries? Do you need to think about, if you inherit an IRA as a spouse, do you need to think about whether you should take ownership and be treated, have the rules apply with you as the owner, or would it be more beneficial for you to take as a beneficiary and have the stretch over your lifetime as an eligible designated beneficiary? Maybe you've decided that actually what you need to do is get yourself to an attorney or get yourself to a qualified financial advisor. Each of you is going to be different. But whatever your decision is, there may be some links that can help you pursue what you want to do on my webpage at KarenChanFinancialEd.com. You'll have, it has tabs across the top like every website. Go to the resources tab and select getting the most from your retirement dollars. That's where you'll find most of the links to more information about the things we've talked about today. If it's information that I talked about that was specific to the CARES Act today, instead of going to the resources tab, go to the tab that's labeled COVID-19 and your finances. Those will probably be the two main tabs where you will find things that will help you with this. And the third thing that, before I go to the final bullet there, the third thing you might find helpful is under the resources tab, I also have links that might help you figure out if you do need to work with a financial professional, how should you search for one and how should you make the selection. I do a program called Finding Financial Advice That's Right for You. And there is a list of resources. If you go to the resources tab and on the pull down menu, select Finding Financial Advice That's Right for You. You'll find tools there to help you understand the different types of financial advisors that we have under US law, what requirements they have about how they serve you, and how to conduct a search and an interview. to choose the one who's right for you. And the stuff about the trusts and the impact of the Secure Act rules on how beneficiaries take distributions from retirement plans, the go-to guy on this is the Nerd's Eye blog. Michael Kitces is the guy behind all of this, although I think this particular post was written by who he calls his chief nerd. The blog post is called The Partial Death of the Stretch IRA. And although it's written for financial planners, I think if you're in the situation of either having a trust named as a beneficiary or considering it, this will be like required reading for you and perhaps for your financial advisor. And even if you're just trying to understand, if you don't have a trust, if you're trying to understand how the rules will apply to the people you have named as beneficiaries, I think you'll also find that article heavy, but very enlightening. So Ashley, with that, I think we should open up and see what kinds of questions we've got coming in.
We have plenty. So here's the first one. This one's just kind of for you to reiterate something. She says, please repeat the correct language for distribution as a beneficiary. You said the account of John Doe for the blank of Jane Doe.
Okay, this is right. When you inherit an account, when you first inherit, the titling on the existing account would previously have been, the IRA of John Doe. When John Doe passes, the titling of that account will change somewhat. It will still be the IRA of John Doe, but it will now also say for the benefit of Jane Doe. So you're now recognized as the beneficiary. If you move that account somewhere else, if you roll it over, remember you have to do a direct rollover. You cannot do a 60-day. That new account has to retain that titling. So just remember, it has to retain the name of the deceased. The titling can also mention you, but only as the beneficiary. If the account title gets changed so that it now says it's the IRA for Jane Doe, you have a problem because that's actually a distribution. The one exception would be if you are the surviving spouse. A surviving spouse can rename the account in her name, but that's the only situation where that can happen. Hope that helps.
Okay. Okay, hold on. So there's, how can the $10,000 charitable distribution be compared with standard deduction 24,800? But then they re-ask, he said, I misunderstood the $10,000 charitable distribution concept in my earlier question. So when you donate that $10,000 to a nonprofit, is it added to the 24,000 standard deduction for tax purposes?
If you make a qualified charitable distribution from your IRA, you get, it's not actually a deduction, but it's $10,000 of income that is no longer taxable. You get to subtract it out in the income section. And so yes, that $10,000 reduction in taxable income is in addition to the standardized deduction. And what we were comparing that with is somebody who did not make their contribution via their IRA as a qualified charitable distribution, but just wrote a check to the charity. And then it's an itemized deduction. And they are, in most cases, they are simply not going to get as much tax savings by doing it as an itemized deduction as if they had done it as a qualified charitable distribution. That's the bottom line.
Okay, can named beneficiaries on an IRA be changed?
Always. Always. As long as you, the owner, are living, you can change it whenever you want. And even your executor can play some games with that up until I think it's October 31st of the year after you die. They can actually like pay out one beneficiary so that only the others are considered in terms of calculating the distributions. Those tricks are probably going to become less popular under the new rules because life expectancy is no longer the driving factor. But yes, you can always change a beneficiary. Your account provider, the custodian, should have a simple beneficiary form that you use to do that. And surprisingly enough, it's not a bad idea, especially if you have large accounts, to involve your attorney in the writing of those beneficiary designations, particularly if you have, let's say you have 3 children and you want to make sure, what do you want to happen if one of your children passes and the other 2 survive? Do you want it to be divided between the 2 remaining children? Or do you want that deceased child's part to go down to the secondary beneficiaries? And the exact wording of the beneficiary designation controls that. So many situations are straightforward. It's like you name your spouse as your primary and then your kids are your secondary. But if you have more than one primary beneficiary, either do some reading and study on your own or get your attorney to help you quickly draft the correct wording.
Did you, I think I cut out a second. Were you looking at the chat? There was a question about, I think the same thing. I'll just read it. It says, husband has an IRA with wife as primary beneficiary and adult child as secondary beneficiary. If husband dies and wife receives IRA as an inherited IRA, titled as wife's name as beneficiary of husband's name, does the adult child automatically become her primary beneficiary? Or is wife free to name that adult child or anyone else as her primary beneficiary?
Okay, great question. If the wife takes it as a beneficiary, she cannot change anything. She will be able to take distributions over her lifetime, and upon her death, the child you had named as your secondary beneficiary starts to take the distributions and will have 10 years to empty the account. If your wife renames it in her name as the owner, then she could rename beneficiaries, but only if she takes ownership of the account. And like I said, that one slide kind of helps you see some of the decision making behind. Depends on your particular situation, which one is going to be the wiser choice.
Can an IRA rollover go into a special needs trust?
No. A special needs trust is not a retirement account. There is no you can take money from your IRA and put it into a special needs trust, but it will not be a rollover. It will be a distribution from the IRA, taxable if that was tax deferred money. And then simply, it wouldn't matter that where the money came from then when you put it into the special needs trust. But I'm not aware of any special provisions that allow for that.
Does it make more sense to name many minor grandchildren rather than just a few adult children as beneficiaries of an IRA? You might make your kids mad.
Yeah. Well, yeah, there may be non-financial drivers behind that decision, but if it's a large account, one of the attorneys, I think it was Ed Slott, who's the IRA rules guru, I believe it was him who pointed out that is the way to have each individual have smaller taxable income amounts each year from a very large IRA, is to spread it around with more people. And so there can be some financial logic behind doing that.
And then if there's a different president, can there be changes to the Trump tax laws, and how will that affect all of these things that you've talked about?
Okay. First, let's talk about if there is no change. Then we know that in 2026, the amount of assets that will be subject to estate tax, we know that the size of the taxable estate will go from 11.5 million down to around 5 million. We know that income tax rates will go up when the current law expires. All I can tell you about new law between now and 2026, every Congress has the right to make changes to existing law. And so it is very possible, especially if we have both one or both houses of Congress and the presidency in the same party, that makes it easier to get those kinds of changes done. I have not read carefully Joe Biden's proposal for tax reform. I know that he has said that he would not increase taxes on anyone making less than $400,000 a year. And I know he has reiterated that numerous times. That implies that his goal is not total repeal of Trump's tax breaks, but selected changes to it. And unfortunately, I haven't read any more to give you more detail about that. And we also know that what we hear on the campaign trail is not always what transpires down the road, because there's always negotiation in order to get legislation passed. So I think on that question, we just have to stay tuned. Unfortunately, I'm not a good prognosticator.
All right, Karen. Well, you amaze me with the things that you know. I don't even know how you do that, and how you do this for libraries. It's amazing. You could be rolling in the dough if you were taking that to the streets. I don't know. So thank you so much, and visit her website if you had other questions that you wanted to have answered, or if you were looking for more information about this. We are recording, so it will be available to go back and review for the next 2 weeks on the library's YouTube channel. And you can share it with your friends and family who just need to get to the bottom of retirement distribution. Thank you, Karen.
It's always a pleasure. Thank you.
Have a good week. Bye-bye.
Bye.